about 5 things that don't matter, in my opinion. Short-term events, short-term performance, short-term trading, hyperactivity, and volatility should not matter to a long-term fundamental investor. Einstein said that the definition of insanity is doing something over and over and expecting a different result. I think another version of insanity is doing the same thing in an entirely different environment and expecting the same result.
How does the rate environment affect asset prices, Howard? How do they position themselves?
Now you're talking, because interest rates constitute our environment, just like water is to fish, and they determine economic activity, and they determine the value of assets because, among other things, the value of an asset is the discounted present value of the future cash flows, and when you decrease the interest rate, you increase the discounted present value. So it's a direct relationship, because I try to dissuade people from caring too much about short-term events. And I wrote a memo in November of 22, which got relatively little attention, called What Really Matters. And I talked in there about 5 things that don't matter, in my opinion. Short-term events, short-term performance, short-term trading, hyperactivity, and volatility should not matter to a long-term fundamental investor. And I mentioned in there that in 2017, for example, the only question I ever got was, what month is the Fed going to start raising interest rates? And I would say, well, why do you care? If I tell you March, what will you do? And if I tell you, oh, no, it's not March, it's May, what will you do different? And people ask about these things that, in my opinion, have no importance. The day an interest rate action is announced, that may influence prices that day and maybe the next day, but it doesn't influence the course of events. That will determine based on long-term policy and on the larger economic environment that materializes. So I don't care about the guidance. I made the case in late 22, which I called a sea change, that in 1980, I had a loan outstanding from a bank personally, and I got a slip in the mail that said the rate on your loan is now 22.25. And 40 years later, in 2020, I was able to borrow at 2.25. And so rates came down by 2,000 basis points over 40 years. And anybody who came into this business since 1980, which I imagine includes most of you, have only seen declining interest rates or ultra-low interest rates or both. And I don't believe that the next 10 years will be characterized by declining interest rates or ultra-low interest rates. And that's a major change in the environment. And the declining interest rates over that period and the ultra-low interest rates were like a moving walkway at the airport. And you get on the walkway, and you walk at your normal speed, and you make great progress over the ground, and you say, boy, I'm fit. But it's not you, And in the same way, people made certain decisions, and companies made a lot of money over the period you mentioned, 09 to 21, which was really the easy time, because the Fed funds rate was 0 most of the time and averaged 0.5%. And the people who made those decisions say, boy, I'm a good decision maker. But it was the rates. And Einstein said that the definition of insanity is doing something over and over and expecting a different result. I think another version of insanity is doing the same thing in an entirely different environment and expecting the same result. So the things that worked the best in a period of declining and ultra-low rates will not necessarily be the things that work best in a period of stable and generally higher rates. And people have to accept that. And so I look at the Fed to try to figure out which it's going to be.